Good morning, everyone. Welcome to an episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is pleasant surprises or rude shocks. Risk sentiments picked up last week alongside revelation of an increase in traffic along the Straits of Hormuz, while Trump alluded to being in the final stage with regards to the US-Iran war. While the desire to de-escalate is clear, the dearth of details implies that markets may be in for rude surprises. Specifically, even with the deferment of a nuclear issue, talks of a toll system for Hormuz between Oman and Iran will be difficult to find compliance from Trump. Over the weekend, there were signs of further progress on the deal, with details such as a 60-day ceasefire emerging. Other details include an easing on the blockade of Iranian ports, the phased sanction reliefs, and unfreezing of Iranian assets held overseas. To be clear, without an actual agreement, details are hardly symmetric at this juncture, aside from the desire from a continued ceasefire. Attempts to link nuclear commitments from Iran and unfreezing of Iranian assets is meeting resistance from Iran, as US officials stated, "No dust, no dollars." US President Trump has pared back hopes of a quick deal as he went from announcing a deal shortly on Saturday to asking his representative not to rush into a deal on Sunday. This is yet another reminder that the dust on Hormuz is far from being settled. Across the Atlantic, the ECB continues to grapple with stagflation risks as weaker activity indicators collide with higher energy prices. The divergence even within the ECB was apparent, with Olli Rehn stating that there is potential need to hike in order to protect credibility, while likely incoming Bank of France Governor Emmanuel stated that the ECB must be able to take into account the impact of its decisions on growth. In Asia, Bank Indonesia last week opted for a surprise 50 basis point rate hike, as ensuring rupiah stability took precedence. The magnitude of the hike, taken together with measures such as intensifying intervention, reflected the authorities' clear focus on restraining rupiah depreciation. To further arrest pressures on the rupiah, President Prabowo announced the setting up of a state-owned enterprise under Danantara to centralize exports and address the inherent issues of under-invoicing and shore up state coffers. The restrictions will apply to coal and crude palm oil in the initial stage. Initial market sentiments have been rather negative, and the announcement failed to arrest rupiah weakness, as questions remain around execution given the operational complexities of consolidating export activities. While Danantara has emphasized a market-friendly, profit-oriented mandate, outcomes will likely depend on effective implementation. In Thailand, as expected last week, Q1 GDP printed on the upside at 2.8% year-on-year, boosted by strong investment spending and government consumption. Private consumption growth was steady rather than buoyant. These underlying compositional details, along with softening momentum in the tourism sector in these recent months, back the case for a prolonged rate hold by the Bank of Thailand. Down under, Australia's employment came in lower than expected, while the unemployment rate picked up. That said, the pace of employment gains this year fits well within pre-COVID trend, and an uptick in unemployment rate may well be within adjustment mode. Moreover, the employment decline, driven entirely by female unemployment, may be reflecting one-off redundancy exercises in public administration or healthcare sector. Looking ahead, Australia's CPI print for April will be in for a wild tussle, as markets grapple with getting a grip on the impact of the fuel excise tax cut and upside risks from the pass-through of elevated costs. We remain constructive on the Aussie dollar. In Korea, we have an RF consensus call for the Bank of Korea to hike rates this week by 25 basis points. Rising housing prices in Seoul, triggering debt sustainability concerns, compound onto pipeline inflation risks to make a reasonable case to take an insurance hike. All in, markets leaning hard onto optimism for a deal surrounding the Straits of Hormuz may face the need to recognize the near-term relief may need to contend with the possibility of tolls and reduced traffic. Meanwhile, major FX will have to deal with the tyranny of elevated oil prices, US yields, and hope that the US-Iran conflict deliver pleasant surprises rather than rude shocks. All in, while markets attempt to take comfort with the ceasefire and partial passage of LNG tankers, simmering inflation risks may still be the growing threat. For more information, please refer to our week ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.